Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Zakwan bin Muhammad Rashidi. I want to talk about my individual assignment, capital asset pricing model and working capital management. Theory of capital asset pricing model. What is capital asset pricing model? Capital asset pricing model is a tool that explains the relationship between systematic risk and also the asset that are expected to be returned. Capital asset pricing model is used to ensure that the price of risky security can be determined. It is it is also used to generate expected return for asset based on the risk of asset that has been given and also capital cost. The model provides a risk quantification methodology and translate the potential return on equity to asset. Formula of capital asset pricing model have three components in this formula. First is premium of risk-free, second is beta, and third is premium of risk market risk. Meaning of premium of risk-free is a value given to an investment that guarantees that it has no risk. For beta is a measure of stock volatility in general to the market. Last is premium of market risk. The anticipated return to investor from holding risk package portfolio instead of risk-free asset. Advantage of capital asset pricing model. First is a good choice model. The CAPM are now as being used in a finance world in order to calculate the equity cost and also at the end to calculate the capital cost in weighted average. This is being used widely to monitoring the financing costs from different information. Second is have variable in business and financing. If the company mix and funding varies from the existing business when investigating alternative, then the weighted average capital cost WACC cannot be used for other essential rendering calculation. The CAPM can, however, for disadvantage of capital asset pricing model, first is not represent the future return. Market return may be regarded as the sum of the market capital gains and dividend. There is an issue when the return of the market can be negative at any given period. As a result, the return is moved by the long-term market return. Second is unrealistic toward investor. Capital asset pricing model consists of four main assumptions, one of which reflect an unrealistic image of the real world. In practice, this assumption that investor may borrow and loan at risk-free rate is inaccessible. Individual investor cannot borrow or lend at the same rate as the government. Theory of working capital management. What is working capital management? It can be defined as the strategy of business that designed to make sure that a firm using their asset and liability at their best. The purpose of working capital management is to make a company can maintain their sufficient cash flow. The management of working capital also to make sure the firm achieve risk return trade-off that at the end of the day will make the value of the firm in maximum level. There are three policies that a firm or company can use the management of working capital. There are three financing strategies in management of working capital. For the first one, it is now as relax policy. This policy is now to be as a very low risk policy. In this policy, a company or a firm will make sure that they maintain their amount of current asset in high value, and it also linked with a liberal credit policy. In this policy, the firm will be in high liquidity position, and also weak investment return. Second, it is now as a moderate policy. This policy position is between relax and retreat policy. It is because the policy provide a moderate of risk and also moderate of return. In this policy, the firm will be in maintaining liquidity position. This policy almost the same like relax policy. Lastly, it is now as a retreat policy. This policy is now to be a high risk policy. In this policy, the firm will reduce their holding current asset to lower level connected with stringent credit policy. The investment that lower in current asset then can make the firm increase their investment in other investment which are productive. Type of working capital strategy. First is aggressive approach. High risk. The firm will use short-term or temporary financing to support a large portion of current asset. Second, hedging approach. Match the maturity of asset and liability. The firm will use temporary financing to finance temporary current asset and permanent financing to finance permanent asset. Conservative approach. Lowest risk. The firm will use long-term financing for majority of their advantage of working capital management. First is profitability being increased. If the firm apply the strategy of management of working capital properly, it will help the firm to increase their profit in the long-term period. Policy in the management of working capital will make the inventory of the firm being managed properly, and thus will avoid the failure of operational in the firm. Second is liquidity in secure position. Most of the firm or company have trouble due to having low money to pay their short-term debt and also for operational costs. This happen due to no management of working capital policy being applied in the company. The management of working capital will guarantee that the liquidity in a safe or secure position by checking the account receivable, management the stock, and also management of the debt. Disadvantage of working capital management. Focusing on monetary element only. The strategy in management of working capital only focusing in monetary element only. The items such as the debt, receivable word, the complete goods word, and other being the key factor while applying in it is in the company. The other non-monetary elements such as recession, government changing the policy in the industry, and other not having important relate with this policy. Second is having bad situational. The management of working capital now that is not situational in their behavior. It mean that the management of working capital only really rely on the figure and event from the past only, and does not recognize the market situation that will suddenly change due to newly situation.